Let me hit you with something wild right out of the gate. What if the entire economy you see around you, the jobs, the banks, the stock market, the money in your pocket is just the cover story? What if the real financial system, the one that decides whether your rent goes up, your savings shrink, or the world melts down, is hidden in plain sight, and it's 8 times bigger than the entire global economy? Yeah, not exaggerating. Today we're diving into the $800 trillion shadow market the Fed hopes you never noticed. And here's the nasty truth. You're already living under its consequences. Sky-high inflation, booming personal debt, insane housing prices. Every single financial pain you're feeling today is connected to this invisible monster sitting behind the curtains, quietly pulling the strings. So let me ask you something. What if that monster isn't a glitch in the system, but the system itself? Before we go deeper, do me a favor and drop where you're watching from in the comments. I love knowing where our global crew is tapping in from. And if you want the unfiltered truth that nobody on TV will ever dare to say, hit that subscribe button so we stay connected. Alright, let's get into it. You were probably taught a very cute, simplified version of financial history. You know the one. Banks took deposits. Banks made loans. Central banks protected the economy. Regulators kept things safe for everyone. But honestly, that was a fairy tale, the bedtime version. The real story starts in the 1970s. This was the decade inflation exploded and, most importantly, the US dollar was unpegged from gold. The moment that connection was broken, everything changed. Money stopped being anchored to something real, something tangible. It became pure imagination, just numbers on a screen, completely manipulatable by anyone smart enough or bold enough to game the system. Sound a little too familiar? Then came the 1980s, when politicians decided to deregulate everything in sight. They called it financial innovation. A great buzzword, right? But that innovation quickly turned into loopholes, and those loopholes turned into financial weapons. And that's when the first wave of what we now call derivatives was born. Now, derivatives were supposed to be safety tools, little insurance policies to protect against market swings. A farmer might use one to lock in a price for their crops, for example. But Wall Street looked at these contracts and didn't see safety. They saw a full-blown casino. Suddenly, banks weren't just managing risk, they were manufacturing it, packaging it, and selling it for obscene profits. And that's when finance went from being slow and, frankly, a bit boring to hyper-complex and dangerously profitable. By the time the 1990s rolled around, derivatives had evolved into something nobody could fully understand anymore. Not the regulators, not the politicians, and not even some of the bankers who were trading them. They were designed to be opaque, and the profits were just too addictive for anyone to want to stop the party. Then came 1998. A hedge fund called Long-Term Capital Management, a firm with less than $5 billion in capital, nearly blew up the entire global financial system. Why? Because it was secretly tied to over $1 trillion in derivatives exposure. That was the first major warning shot, a clear signal that this new shadow market could nuke the entire financial world. So, did regulators crack down? Did governments impose limits? Did central banks wake up and smell the coffee? Nope, they did the exact opposite. They looked the other way. Does that pattern sound familiar at all? Let's fast forward into the early 2000s. This is when things really got out of hand. You've heard the terms mortgage-backed securities, credit default swaps, synthetic CD. This was Wall Street engineering at its most reckless. These products were designed to carry the illusion of safety. They had AA ratings slapped on them. They were sold by respectable folks in expensive suits, with smiling CEOs on magazine covers. But underneath all that polish, they were ticking time bombs, and the entire world was sitting on them without even realizing it. Here's the truth. 2008 wasn't a housing crisis. It was a derivatives crisis. The financial system collapsed because a few $1 trillion of these toxic contracts all imploded at once. And the elites who built this system, the ones who caused the meltdown, they got bailed out, they got bonuses. They actually got stronger, and who paid the price? Everyone else. You, me, our families, our neighbors. But here's the plot twist nobody ever talks about. 2008 wasn't the end of the derivatives system. It was the beginning of the next, even more dangerous phase. Because instead of shrinking the monster, the Federal Reserve quietly merged with it. After the crash, central banks around the world, led by the Fed, created a network of hidden liquidity pipelines, things like currency swap lines, repo market injections, and unlimited emergency lending facilities. They plugged themselves directly into the shadow banking universe. What you were told was a rescue was actually a surrender. The big banks realized they had discovered a cheat code. They could write unlimited derivatives, take on unlimited risk, because the Fed would always show up with unlimited liquidity to backstop their bets. And this is when the shadow market truly exploded. It went from $600 trillion before the crisis to $700 trillion to an estimated $800 trillion today. This system is no longer the sideshow. It is the main event. It is the system. And the person who quietly enabled the modern version of this entire structure isn't who you think it is. You won't believe the name. And the proof is wilder than you can possibly imagine. Alright, Let us peel back the curtain on the part of the economy they never want you to understand. Because once you grasp the mechanics of this shadow market, you'll never see things the same way again. Think of the real economy: your job, your rent, the price of gas as the first floor of a building. That's where you live. It's the world you can see. It feels solid, real, and somewhat predictable. Now, imagine a hidden second floor built on top of yours. A massive, unstable structure made of fragile paper contracts, stacked all the way to the ceiling. That second floor is the derivatives market, and if it collapses, it falls directly onto your floor. You're not part of it. You didn't choose it, but you're the one who gets crushed. So what is a derivative? At its core, it's a financial contract, basically a bet. Sometimes it's used as a hedge, like insurance, to protect against risk. But most of the time, it's pure high-stakes speculation. Here's the trick that makes it so dangerous. These bets are often 100 times bigger than the actual assets they are based on. Let me give you some perspective. The entire world's economic output, the global GDP, is around $105 trillion. That's every product, every service, everything created in a year. The derivatives market, it's estimated to be over $800 trillion. Let that sink in for a moment. The shadow market of bets is almost 8 times larger than the entire real-world economy. It's a colossal inverted pyramid balancing on a tiny point. Now, here's where it gets really dark. You'd think a market this huge would be transparent, right? Wrong. The vast majority of derivatives aren't traded on public exchanges like the New York Stock Exchange. They're traded over the counter in secret deals between giant financial institutions. There's no public price ticker, no real oversight, no public accounting of who owes what to whom. This market is invisible by design. It's a black box, and when things go wrong in that black box, the consequences are astronomical. Remember the panic in March 2020. As the world was locking down, the Federal Reserve quietly injected over $9 trillion into hidden liquidity facilities. That's not a typo. 9 trillion. The public never got the full details. We never saw the names of the institutions that were on the brink. We never saw what collateral, if any, was posted. Why? Because this wasn't about saving Main Street. It was about preventing the shadow system from completely detaching from reality and triggering a catastrophic chain reaction. This brings us to the second half of this beast: shadow banking. This isn't your local community bank. We're talking about hedge funds, private equity firms, asset managers, and money market funds. They're not regulated like traditional banks, but they act like them. They lend, they borrow, and they leverage up their bets on a mind-blowing scale. And here's the kicker. These shadow banks hold more derivative exposure than the actual regulated banks, but they don't have the same safety nets or protections. So when they get into trouble, guess who becomes their ultimate backstop? You guessed it, the Federal Reserve. Not because they want to save a hedge fund, but because if even one of these major players implodes, the shockwaves could bring the entire global system to its knees. Let me drop 5 numbers that should make you sit up and pay attention. 1. Just 5 US banks hold over $200 trillion in derivatives. That's more than double the entire world's GDP held by a handful of institutions. 2. One single European bank holds $49 trillion in derivatives. That is more than double the GDP of the entire European Union. 3. Only about 4% of all these global derivatives are centrally cleared, meaning they have real collateral backing them up in a transparent way. The rest, it's a web of promises. 4. A staggering 88% of all derivatives are held by fewer than 10 global institutions. The concentration of risk is almost unbelievable. And 5. Remember the repo market hiccup in September 2019? A tiny $75 billion shortage in overnight lending forced the Fed to inject over $1 trillion in a matter of weeks, just to keep the plumbing from freezing. Do you see the pattern? This system isn't stable. It's a balloon that's been stretched to its absolute limit, and then stretched some more. Now for the big reveal I teased earlier. You might think this system was engineered by some rogue Wall Street banker, but the modern derivatives explosion wasn't primarily their creation. It was championed by Alan Greenspan, the former chairman of the Federal Reserve, the very man who was supposed to be the guardian of financial stability. He aggressively fought against oversight. He promoted deregulation. He truly believed that these massive complex markets could self-regulate. He didn't build a safer financial system. He built a global time bomb. And every Fed chair who has come after him has been forced to keep feeding this monster just to prevent it from detonating. Let this sink in. The central bank doesn't really control the derivatives system anymore. The derivatives system controls the central bank. This is the fundamental reason why every single crisis, big or small, triggers the exact same response. Unlimited liquidity, unlimited backstops, and unlimited support for the financial system. It's not because the public needs saving, it's because the shadow market must survive at all costs. So here's your final warning. This system is faster now, it's more global, more interconnected. It's run by algorithms trading in microseconds, and it's completely dependent on an endless supply of instant liquidity. The next collapse won't look like 2008. There won't be weeks of slow-motion crisis. It'll be sharper, quicker, and far more contagious. And the fallout will hit regular people like us long before the elites even feel a scratch. Because when you build a financial world on illusions and paper promises, you eventually drown in them. I want to know what you think. Drop your thoughts in the comments. How do you see this now? Tell me this. Are we wiser today, or are we just walking down the same dangerous path in better-looking suits? If you're ready for more deep-dive breakdowns that the mainstream media tries to bury, you know what to do. Thanks for watching.